Treasury yields posted their biggest weekly gain in years after Fed minutes released the jobs report. Treasury yields posted their biggest weekly gains in years, helped by further advances in most rates on Friday as traders focused on positive elements of the December jobs report likely to keep the Federal Reserve on an aggressive track toward tighter policy. What are yields doing? The yield on the 10-year Treasury note MUBMOS 10Y 1.767% rose 3.6 basis points to 1.769%. Up from 1.733% at 3 p.m. Eastern on Thursday. It rose 27.3 basis points this week for the biggest weekly gain since the period that ended September 13, 2019, according to Dow Jones market data. Yields and debt prices move opposite each other. The 30-year Treasury bond BX MUBMOS 30Y yield rose 2.3 basis points to 2.116%. Up from 2.093% on Thursday afternoon. It gained 22.8 basis points this week, the biggest weekly gain since the 5th of June 2020. The 2-year Treasury yield MUBMOS 02Y 0.866% fell 1.2 basis points to 0.868%. Versus 0.88% late Thursday afternoon. Still, it gained 13.8 basis points this week, the largest weekly gain since the 11th of October 2019. What's driving yield? December's jobs report showed only 199,000 new jobs were created, significantly below the 422,000 gain expected by economists surveyed by the Wall Street Journal. Meanwhile, the unemployment rate slipped to 3.9% from 4.2%. Still, the data contained enough positive elements, such as a declining unemployment rate, higher average hourly earnings, and job gains in previously hard-hit sectors like leisure, to keep expectations intact for an aggressive start to the Fed's next rate hike cycle. Read, traders, undeterred by December's lousy job gains, continue to price in sooner and faster tightening by Federal Reserve after the jobs report was released Friday. The odds of a 25 basis point rate hike at the Fed's meeting in March hovered around 70%, close to where it was a day ago, according to the CME FedWatch tool. Meanwhile, San Francisco Fed President Mary Daly said she could imagine starting to shrink the balance sheet after 1 or 2 hikes. Her comments came a day after St. Louis Fed President James Bullard, a 2022 voter on the rate-setting Federal Open Market Committee, said the first rate increase could come as soon as March. Minutes of the Fed's December policy meeting, released Wednesday, showed that officials felt it might be necessary to increase the federal funds rate sooner or at a faster pace than participants had earlier anticipated. The summary also showed that Fed officials had a wide-ranging discussion of how to move away from their current easy stance by hiking rates and shrinking the central bank's balance sheet. What are analysts saying? A long-standing view held within the Fed is that monetary policy should be preemptive to avoid a wage price spiral, said Ben Emmons, managing director of global macro strategy for Medley Global Advisors. Real earnings are holding up in a healthy sign that a tightening labor market is not derailed by rising wage costs, and yields are higher because the report is not accounting for Omicron likely tightening labor markets even further. Sign up for our Market Watch newsletters here.